Hey everyone, and welcome. Have you ever thought about trading gold or silver, but just found the old school markets a little, well, clunky? Today we're diving into a really modern twist, how you can trade these precious metals using crypto. Let's get right into it.
So let me ask you this. Have you ever seen that perfect trade setting up in gold or silver? You're ready to jump in, and then you see the entry cost and just can't? Yeah, you are definitely not alone. It's a huge hurdle that keeps so many of us on the sidelines.
And to put that into perspective, just look at the numbers. In the traditional futures market, the margin, the money you have to put up front to trade a single silver contract, can be an absolutely staggering 26 lakh rupees. That's over 30,000 US dollars. That is a massive amount of cash just to get in the game.
And gold? Well, it's pretty much the same story. A single futures contract there can demand 13 lakh rupees, or over 15,000 US dollars, just in margin. For most of us, that's a gigantic financial roadblock. But what if you could trade the price movements of gold and silver without needing that kind of capital? What if there was a way that was more accessible, more flexible? Well, that's exactly what we're going to dig into right now.
So, say hello to tokenized commodities. On crypto platforms, you're going to see these tickers, XAU-USDT and XAG-USDT. The easiest way to think about them is like digital twins for gold, that's XAU, and silver, which is XAG. Their entire job is to mirror the price of the real thing, tick for tick.
So how does this new crypto way really stack up against the old school futures market? Well, first off, the entry cost. Traditional is super high. Crypto is incredibly low. Then you've got market hours. Traditional markets have opening and closing bells. Crypto markets, they never ever sleep. And finally, leverage. Crypto offers way higher leverage, and we're about to get into what that means.
Okay, let's break this down even more. I want to focus on what I think are the three biggest, most game-changing advantages of trading this way.
Advantage number one is market access. Your typical commodity markets, they're open maybe 40 hours a week. They close at night, on weekends, on holidays. But crypto markets, they're open 168 hours a week. That's 24 hours a day, 7 days a week. They are always on.
Now, why is this such a big deal? Well, imagine this. Some major global event happens on a Saturday. Gold and silver prices are probably going to go nuts, right? But if you're stuck in the traditional market, all you can do is watch. By the time Monday morning rolls around, that huge opportunity, it's gone. With 24/7 access, you can react the second the news breaks.
All right, advantage number two. This one is a really powerful tool. I like to call it amplified trading power. We're talking about leverage.
With these tokenized commodities, you can often get up to 20x leverage. So what does that mean? It means for every $1 of your own money, you can control a $20 position. This can turn even tiny price movements into really significant potential gains.
But, and I need to be crystal clear here, leverage is a double-edged sword. It is not magic. Yes, it can magnify your profits, but it will magnify your losses just as fast and just as brutally. This is a tool that you have to treat with respect, and you absolutely need a solid risk management plan.
Okay, our third advantage is a really fascinating one. It's something you pretty much only see in the crypto world, and it's the potential to actually earn an income just for holding a trade open.
This whole thing works because of something called funding fees. It's a little weird, but stick with me. In certain market conditions, if you place a bet that the price will go down, that's called shorting, you can actually get paid a tiny fee every few hours. Those fees come from the traders who are betting the price will go up. And over time, these little payments can seriously add up. How much can they add up? Well, get this. The analysis in our source material showed that if the conditions and the funding rate stay consistent, these little payments could theoretically result in a 48% annual percentage yield, or APY. I mean, think about that. That's a potential return even if the price of silver itself goes absolutely nowhere. Okay, so we've covered some really exciting advantages. But now it's time to pump the brakes a little and have a reality check. Because this is not free money, and it is absolutely essential that you understand the risks involved. So here's what you have to remember. First, and it's worth saying again, leverage cuts both ways. It will amplify your losses. Second, those funding rates we just talked about, they are not guaranteed. They can change in a heartbeat. They can even flip negative, meaning you have to pay the fee. Third, we're talking about crypto markets, right? Volatility is the name of the game. And finally, just remember the golden rule. All trading, no matter what it is, carries risk.
So if you've listened to all those risks and you're still curious and thinking, I'd like to at least see what this looks like, well, finding these things is actually pretty simple.
On a crypto exchange like Binance, you're usually going to look for a section called Futures or Derivatives. Once you're there, just go to the search bar and type in XAU USDT for gold and XAG USDT for silver.
And hey, while you're on these platforms, you might notice some other interesting features. Things like airdrops, where you can get free tokens from new crypto projects, or copy trading, which actually lets you automatically copy the trades of more experienced users. Just some other things to be aware of.
So this all brings us to the big question, right? Are these digital tokens the future of commodity trading for the everyday person? You know, they offer access like we've never seen before, but they definitely come with a whole new set of rules and risks. The power, as always, is in the hands of the trader who's done their homework. Thanks so much for tuning in.